Alright, welcome back to the Junius Maltby channel. This is going to be one of those videos that takes us back to the very roots and origins of this channel, which is sheer and absolute boredom. A lot of visuals as far as charts go, and lots of words and discussion. There's several articles here we pulled up, and we're going to touch on the recent events, the Fed raising the rate, and the recent performance in metals and the little dip in the dollar. All of it's going to tie in. It's kind of all, one giant story broken up into several different articles. So we'll touch on those. So if you're just getting ready to get tucked into bed, you should probably fall asleep here before we even hit the second chart. If you're interested, stick around. You might hear a thing or two that perks your interest, but there is some interesting stories here, interesting information. We'll get right into it. The Ides of March. Gold, $14,463. Silver, $669. Nice little attention grabber there. This is from Egon von Greyerz and Matterhorn Asset Management. We're not going to read the entire article. We just can't afford the time to read every single article, but there's some cool information in this one. He talks about the Roman calendar. The Ides of March was the same as March 15th in today's calendar. The date was not significant until Julius Caesar was assassinated on the 15th of March, 44 BC. Shakespeare then coined the phrase, "Beware of the Ides of March," in his Julius Caesar work. So, will March 15th, 2017 be significant? We'll soon know. There's some noteworthy events taking place on March 15th. The debt ceiling must be reset that day. And the Fed also meets to discuss a rate hike. As you know, this is the past. So March 15th is a few days ago, and the rate hike did take place. In addition, there is the Dutch election on the same date, and 8 days later, the French election starts. In normal circumstances, none of these events would be earth-shattering or have major consequences for the world economy. But we don't have a normal world, far from it. We have a world which is financially and morally sick. Regrettably, the condition is so dire that there is no cure for a reprobate world. A $750 quadrillion worth of U.S. risk. A 100-year debt explosion has created a time bomb waiting to explode. Very little is required to light it. As the biggest economy in the world, the U.S. obviously has the biggest debt with a total of $65 trillion. To this, we need to add unfunded liabilities of around $200 trillion and derivatives of circa $500 trillion. Thus, we are looking at a total U.S. risk of $750 quadrillion. Many critics would say that this is a vastly exaggerated figure since it won't all be payable in one go. But that risk is much greater than anyone can imagine. Let's just assume that there will not be an early agreement to increase the debt ceiling. That would trigger major falls of the dollar and bond markets, and probably also the overvalued stock market. The repercussions would be higher rates, higher import prices, bigger budget and trade deficits, and more money printing. Inflation will increase rapidly, and eventually, as the dollar falls precipitously, it will lead to hyperinflation. More money printing, yet higher rates, in an unstoppable vicious cycle. The derivatives market, which is extremely sensitive to higher interest rates, would also come under pressure, leading to more money creation by the Fed. This is a chart showing the U.S. debt and debt limit versus gold. The U.S. debt limit in black, $18.113 trillion. The U.S. debt today, $19.895 trillion. U.S. gold today sits at $1,234.42 an ounce. Statutory debt limit temporarily suspended through March 15th, 2017. Here we see U.S. inflation zooming up to a 5-year high. We covered this story just about a week or so ago, and it talked about the inflation coming back. Now looks that inflationary pressures are starting in earnest. The official inflation figures are substantially below what ordinary people experience when they buy their food or pay their health insurance. But even the official inflation figures are now indicating that inflation will grow rapidly. In the last 2 years, inflation has gone from 0% to 2.5%, which is a 5-year high. As the dollar falls and velocity of money increases, we will see inflation increase rapidly. It could easily reach 10% in the next couple of years. That might seem incredible today, but it happened in the 70s when the 10-year Treasury went from 7% to 16% in 4 years. In the UK, the inflation rate was in the teens between 1972 and 1980. I remember it well. My first mortgage went up to 21% in the mid-70s. I wonder how many people today can hold on to their houses at that kind of rate. Probably less than 5%. It shows the chart again there of the inflation rate going up. And the same thing is happening in the EU. Inflation is back and on the way up to much higher levels. From negative 2% a year ago, EU inflation is now at 2%. Like in the US, we will see EU rates climbing above 10% in the next couple of years and ultimately a lot higher as inflation turns into hyperinflation. And there's a chart showing the EU inflation rising fast. It also mentions US dollar weakness coming. The whole world is betting on the dollar to be stronger for quite some time and the euro to collapse. This sounds plausible, but it looks to me that the majority will be wrong, like they normally are. Looking at the euro against the dollar, it seems that the euro will strengthen next and the dollar will lead the race to the bottom. Moving on to the next article, global credit creation comes to a grinding halt. UBS calculates a global credit impulse showing the extent to which there is a trend toward increasing use of debt. According to their calculations, since 2014, it is China that has been keeping the global credit impulse up. If China is cutting back and the U.S. is cutting back as well, the situation starts looking like the 2008 to 2009 period, except starting from greater problems with diminishing returns. Chinese companies are aggressively deleveraging, but deleveraging spelled wrong. It's funny how when I read these articles, I feel like I'm an editor sometimes. I can catch so many different spelling mistakes. China credit creation equals 80% of the world's total and a warning to risky assets. China corporate leverage momentum and the MSCI world. Bank credit growth has slowed down in recent months. This is looking at India. He says, I find it strange that even a relatively less leveraged country like India, as compared to China and the US, is witnessing a collapse in credit demand, where credit growth slumped to 60-year lows. I understand why corporates are not borrowing, but it is inexplicable why households are not borrowing, especially when they are not leveraged. So you can see the India bank loan growth there, dating back to 2013, and it's just plummeting the amount that they are borrowing. And that's a good thing, I think, for the Indian people. Maybe they've stacked so much gold, they no longer need to borrow rupees. The economy, to me, is like a type of Ponzi scheme. In absence of productivity, it depends on both rising energy consumption and rising debt to sustain growth. A major function of growing debt is to add wages. Unwinding debt leads to the kinds of problems that we encountered in 2008. It is tempting for world financial leaders to think that they can find a solution to today's problems by using higher target interest rates to slightly scale back economic growth. I don't think that this is really a good option. Judging from the complete halt in credit creation and the softening energy prices, I fail to understand what will the Fed achieve by raising the rates. Lori Williams writes, cautious Fed sees gold, silver, and a global equities rise, dollar fall. He talks about the chaos that we're seeing in the investment world. With the U.S. Federal Reserve raising interest rates by a small 25 basis points, the dollar fell, gold and silver prices soared, and global equity markets rise. Although U.S. equities have turned down this morning. Some put this down to massive short covering, but others to gold, and particularly silver being previously oversold in any case in an uncertain world, and to the Fed still appearing relatively cautious in its projections. But we should have been forewarned. After a little over 8 tons of outflows from the world's biggest gold ETF, the GLD, over a 5-day period, at the time the gold price was falling, these had been replaced with inflows, with 14.21 tons being added back in over the past 4 working days. The initial 2 days of rises had failed to move bullion prices at all, but this has proved to be a pretty accurate indicator of where the big money is actually going, and it took the markets a couple of days to see this. The fall in the dollar, which has previously been a contributor to the rise in precious metals, seems to be something of an unintended consequence, albeit one which might see approval from the Trump administration. Rising interest rates would normally signify a stronger greenback, particularly as virtually no major competitive economy has raised rates, except China, which has a political motive in the face of Trump rhetoric, but a marginally stronger yuan has little impact on the dollar index. The Chinese may be looking to see the yuan fall long term, but in view of the Trump accusations that the Middle Kingdom is a currency manipulator damaging the dollar through a low exchange rate, discrete control to try and suggest the opposite might be considered temporarily worthwhile. A colleague of this author's also wrote his view on the situation, and in the article titled Rates Up, Gold Up, Why? And in this article on the apparent anomalous reactions to the Fed rate increases, he wrote, essentially, when the U.S. Federal Reserve jawbones a potential move, such as a rate hike for the best part of a year, investor positioning is congruent with the expected outcome. That is to say, dollar and equities up, and by extension, gold down. But what happens when they are too successful in leading the market's expectations and the gold positioning is too extreme for the expected move? Well, you have a heap of investors who are short gold and long the dollar equities, who don't get the win they expected. That is to say, the move is overpriced into the news. As such, those investors, be they speculators in the futures markets or physical buyers, who have forestalled their purchases for a hoped-for price correction, are vulnerable. And how? So it looks like investors for the better part of a year have been anticipating and placing bets and pricing in these Fed moves, and they may have very well oversold some of their positions in precious metals, as well as taking up short positions on the metals that didn't pay out like they thought, which of course I believe they deserve. The gold party's back on after Yellen reassures the market. It's from Louisiane Javier, March 16, 2017. Call options for the 1250 an ounce gold sees volume triple. Futures on course for steepest price gain in 8 months. Call it a comeback. Bullish gold options surge on Fed rates outlook. 3 interest rate hikes are already baked into the price, and this is our base case, said Naeem Aslam, the chief market analyst at Think Markets UK Limited. It may be foolish to stay on the short side when it comes to the precious metal. We'll say that again. It may be foolish to stay on the short side when it comes to the precious metal. Gold futures for April delivery advanced 2.2% to settle at $1227.10 an ounce at 1:40 p.m. on the COMEX in New York, the biggest gain for a most active contract since June 24th. The metal headed for its first weekly increase since February 24th. And in other precious metals, silver futures had the steepest ascent in 2 months on the COMEX, while platinum and palladium futures climbed on the New York Mercantile Exchange. Gold on pace for the best weekly run since early February. Gold, silver sharply up amid bullish outside markets. Kitco News wrote about how gold and silver prices are sharply higher on the early U.S. trading Thursday. The precious metals bulls have been revived after a 2-week meltdown in prices. Short covering in the futures markets and bargain hunting in the cash markets are featured following the recent strong selling pressure. A weakening U.S. dollar index and rebounding crude oil prices late this week have helped to rally gold and silver markets. April COMEX gold was up $31.10 an ounce at $1231.50. May COMEX silver was last up 56 cents an ounce at $17.48 an ounce. Debt, devaluation, and taxes. Big article here. I'm not going to read it all in depth, but this comes to us from Gary Christensen. The world is drowning in debt. $150 to $200 trillion. The U.S. government is sinking into a black hole of debt. $20 trillion official and another 100 to 200 trillion in unfunded obligations. Total U.S. debt securities exceed $40 trillion according to the St. Louis Federal Reserve. Devaluation, given unpayable debt and unwillingness to face the insanity, the remaining option is devaluation. Taxes. Governments need more revenue. It will come from taxes and printing. Both are poor choices. Since 1913, debt has been a necessity for bankers, governments, and businesses. More debt equals more currency in circulation, equals higher prices, including gold and silver. There is practically no chance that debt will stabilize or decrease. Again, there is almost no chance, ladies and gentlemen. It's impossible. Consider total U.S. government debt in 1972, roughly $400 billion, versus today, roughly $20,000 billion, or $20 trillion. Total U.S. debt securities in 1972 were roughly $850 billion versus today, roughly $41,000 billion, or $41 trillion. The following graph uses a log scale and shows that total debt securities have increased about 9% per year since 1971. The gold scale matches the debt scale. Yes, gold is matching and paralleling in somewhat the debt scale. Gold prices have increased along with debt and currency in circulation. Gold bubbled higher in the stagflationary 70s and then languished in the great age of paper, 1982 to 2000. Gold will probably catch up with debt as central bankers rapidly print currencies, which will cause accelerating devaluations in the next several years. Are higher gold prices guaranteed? Of course not. But higher gold prices, given the monetary systems in place, along with overwhelming debt and inevitable devaluations, must rally much higher. The debt junkies of the world, including governments, central bankers, Congress, leaders, corporations, and individuals, will increase debt to continue buying votes, boosting stock prices, and living in excess of revenues. Yes, debt will increase as it has for over a century. How many politicians or presidents have asked Congress to cut spending and balance the budget? Debt will increase. If total debt were to be reduced, the current system would spiral downward into a horrible depression. What politician or central banker desires that outcome? Bet on increasing debt and devaluation, he says. Concerns. Debt will increase, currencies will devalue, and central banks will print to keep the financial system moving and markets rising if they can. How much more debt can the system accommodate? Bonds have rolled over from a 35-year bull market. Is a 10-year bear market from 2016 to 2026 likely? Mortgage interest rates are rising, which are restricting real estate sales and refinancing. Commercial property is weak. How many newly printed out-of-thin-air dollars will be needed to inflate that bubble once again? Regardless of the official statistics, the U.S. economy acts weak and poised to fall further. An excess of debt, rising interest rates, and the blowback from decades of bad policy, poor decisions, wars, and excessive expenditures are a drag on growth. Expect a slowing economy, higher consumer price inflation, recession, or depression. Rising interest rates, higher consumer price inflation, slowing economy, bond bear market, and stocks rolling over indicate stagflation. Welcome to a return of the 1970s, but probably worse. Gold rose from about $40 to over $800 in the 1970s. And into January of 1980, silver rose from under $2 an ounce to over $50 during the same time. They will bubble higher again, sooner rather than later. But you might say, I doubt it. You could be right, but consider the smart money bet on Hillary. How did that work out? Brexit? That wasn't supposed to happen either. Who wins the ongoing currency wars as all countries devalue? Answer, nobody. Will the euro survive another exit? I don't believe so. Gold has been real money for thousands of years. How long have unbacked, debt-based fiat currencies survived before their governments and central banks devalued them to worthlessness? Answer, usually only decades. On average, I'll answer it for him. A fiat currency has a lifespan of approximately 30 to 35 years historically, of the 3,000 that have been studied. When the euro and dollar have become distant memories, gold will still be valuable. Fiat currencies have crashed before, while gold and silver have retained their value, rising in nominal currencies to unbelievable price heights, fading currencies and rising metals in our near future. Here's another article. The world is descending into an economic hell. This is from the Mogambo Guru. And how much debt has sprung from this poison fount of fiat currency? Egon van Greyerts of Matterhorn Asset Management AG writes that global debt going from virtually zero 100 years ago to $230 trillion today. Within this astronomical figure is personal debt that cannot be repaid and government debt that will not be repaid. In addition, there are unfunded liabilities and derivatives in the quadrillions of dollars, at least 2 million billions of dollars, or if you prefer, 2 billion millions of dollars. Either way, a lot of moolah. And with the GDP of the whole freaking world added together being somewhere around 80 trillion, the paltry lower figure of 230 trillion is, gulp, almost 300% of GDP. Closer to home, let's not forget about a towering $20 trillion national debt, or our massive $500 billion per year trade deficit, or the staggering $1.3 trillion in annual federal spending deficits. Also, let's not forget the baby boomers started retiring 10 years ago when they reached 59 and a half, and with the money put into their pension plans all fully invested in the stock and bond and housing markets, and with the banks all fully invested in the stock, bond, and housing markets, and every other depositor's dimes that any banks or investors can get their grubby little hands on, everything is all suicidally invested in those three overpriced, highly leveraged markets. Tens of trillions of dollars could be lost from these never-seen-before nosebleed market valuations going down and still be above real long-term value. History has shown that the value of gold and silver always survive. Such monetary insanities, especially the insane Keynesian jibber-jabber that currently holds the world's monetary system captive and is directly responsible for the bankrupting mess we are in. So in closing, we just covered a lot of numbers, a lot of staggering numbers, and all of these articles somewhat tied together. As you can see, some of the authors even quoted other authors of articles that were in this presentation today, this afternoon. It is sobering, I think, and it even for me, I mean, I read things like this, and it kind of like, man, my eyes open up, and I think, did I buy enough silver and gold recently? Am I stacking enough? What else should I do to prepare for such an economic uncertainty? What is in store? What is coming? And you don't want to be so obsessed with these topics and this issue to where it really impinges upon your life, your happiness. So I try to, I try to balance it out. You still want to maintain your joy and your family time, recreation, go out and enjoy life. We're not going to live forever, and nothing's all about money. But we do need to be somewhat adequately prepared and have a savings plan and have a way to purchase goods and services should the currencies we're normally exchanging expire or go extinct, should your pension die, should your investments go to zero. Most of you who are on this channel and part of the Junius Maltby community, I know, are fully aware of these facts, and you discuss them with others, you discuss them here, and it's videos like this that basically reaffirm and reiterate the points and kind of strengthen our positions, help give us some ammunition, so to speak, when discussing these with our Keynesian aunts, uncles, cousins, brothers, sisters, and siblings, and parents, and so on. I would argue that very rarely, if ever, have I heard rational arguments that paint a rosy picture. I've never heard somebody that could sit there and convince me that no, none of this is going to happen. Everything's great, debt is good, the US dollar and all these currencies are going to be around forever, and everything's great. The debt will be paid off, or it's manageable. Most of the time, I think they're just living and existing in a state of denial, as well as the normalcy bias. You know, it's never happened, they've never experienced it, thus it can't happen and never will. And so they just go on. And as I've mentioned in the past, they can't accept the facts of reality, because if they do, it will then become incumbent upon them to make certain lifestyle changes and decisions which might be uncomfortable, or force them to redirect certain funds away from certain hedonistic pleasures and into the boring and cold and metallic world that is stacking little bars of gold and silver and coins of gold and silver, things that you secure and hide away and really don't entertain you all that much. However, I would say that most of the people in this community do gain a sense of entertainment in handling and discussing their little cold metallic stack. Alright, thanks for being here. Thanks for being part of the Junius Maltby channel. I hope you stuck around for this entire video. It's a long one, and if you did, let me know. And if you liked it, smash the thumbs up button. Go ahead and like these, share them, subscribe, and invite others to join us here on the Junius Maltby community. Appreciate it. Thanks for supporting and being here as always.